Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome back to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
We have been doing this show for many, many decades. I know Guy's voice is a little higher today.
What do you mean?
He had an accident with a power tool. He's actually sick today. That is Sarah. Sarah, my executive assistant, and someone I cannot do anything around the office without.
They got that right.
What we're doing, for those of you that are new to the show, we've been doing this 20-something years. We're off the air for about, 6-8 months. And I guess it was all the protesting in New York at the CBS station. There was so much protesting to get this show back on the air. I believe they had to sell to another company. I think it's Intercom. And they got the protests. And now here we are. So that's what happens. We are back. For those of you, like I said, I was a nuclear chemist for the military. I've been a financial advisor since 1988.
You're old.
I know. Very, very old. But to me, all finance is about math. It's just math. And that's all I've ever done. Guy and I have never had a complaint. He's been doing this about 34 years. I think it's my 31st year. We've never had a complaint because math never lies. A sales pitch is always going to highlight the good stuff, not even tell you about the bad stuff, to show that under the rug. What we do is we just give you the numbers. We're legal fiduciaries. We've been financial advisors. We have to, for all these years, we have to put your interests ahead of ours. Our company's been in business for 30-something years. I actually bought an existing company, and so it's been around since, 84 or something. Long time. And so what we do is we try to answer your questions, in a really plain-spoken, no-nonsense thing, just like the bumper says. I can't stand everybody reciting all the Greek letters every time they talk about investments, because most people don't understand it. They just want it to make themselves sound smart. You want to know the alpha. What's the alpha of that mutual fund? How about the gamma, the beta, the standard deviation? Even if you can recite what they mean, most people really don't know what they mean. That's usually speak between mutual fund wholesalers and brokers. It's not really speak that you should talk to people. Now, the one thing I warn you, if you've heard me before, I do talk a lot of numbers. Because remember, math never lies. Now, I've got 4 kids, ranging from 32 years old down to 9. And not one of them likes math. So I don't know what I did wrong. I don't know what happened. My oldest son, 32, is a professor in New York City. That'll get me to a story we'll go to next. But he's a professor. He's the most liberal human being on the planet. He said Bernie Sanders is a little too far right. And I go, Bernie Sanders, the socialist, is too far right? Yeah. Now, I'm ex-military. His mother's a cop in Plano. How we got the most liberal kid in the world, I don't know what happened. I don't know how. I don't understand what happened. But there's hope for the next 3. I'm always talking to customers and friends, And anytime I tell them about my son's, real big liberal, I love my son. Don't get me wrong. He's a wonderful kid, kindest kid I've ever met. But every time I say that, they look at me like, oh, no. And I go, he's not dead. He's alive. I didn't lose a kid. They go, oh, no, okay. I was like, so that's what we have to deal with. But I was in New York. I was visiting him, but I actually was there for a business trip. And we met a couple of the most famous icons in the financial industry, Roger Ibbotson and Robert Shiller. Now, word of advice. For any of you have been to New York, I had been there several times to visit my son because he went to graduate school there. He went to school like 10 years, but it's not a doctor. That's besides the point. So I've decided I'm going to walk Central Park. It just like I saw it in the airplane, that little thing. Well, it's a lot bigger than you think. I walked it's like 4 miles one way, and by the time I walked in my flip-flops. Don't ever walk 4 miles one way in flip-flops. So then I tried to take a cab, and they said, no, it's too close. We're not going to take you there. And they started locking the door. We were trying to open the cab door. I was like, What? So I had to walk back. And I realized that I'm an old man and shouldn't be walking 8 miles in flip-flops. So that's a lesson that I've just learned. You try to learn something new every year, right?
I think I learned that lesson many years ago.
I know. Everybody's looking at me like, what are you doing in flip-flops? Because I'm trying to look cool. That's why. I got my sunglasses, my shorts, my flip-flops, and I should have had some tennis shoes, running shoes, or something. But we're in New York, and I was at the New York Stock Exchange, okay? The New York Stock Exchange, now I've been in this business for 30 years. I had never been. Guy's been in the business, 34 years? He's never been. And so we said, we need to go. So they were speaking there, so we went there, and it's totally different than I thought. You know, I was offered a job at Rosenthal Collins of the Chicago Board of Trade in the 80s. And I just said I'll never go back to Chicago because I lived there when I was in the military. It was too damn cold. But that was when papers are flying everywhere. People are yelling you got all the different guys with the different color coats. They still have guys with different color coats at the New York Stock Exchange now. But everything is, done electronically. So there's nobody running around. There's just a few people on computers at different stations. One guy walking here. There's no runners like it used to be. There's screaming. There's nothing. It was very quiet, and I was like, I think this is the quietest. It's like a library in here, and this is supposed to be the New York Stock Exchange. So things surprised me. I went to the bull that's in front. I thought it was in front of the steps of the stock exchange. It's not. It's in the street. It's like in a median in the street. So those are things that I learned. Don't walk too long. The bull at the stock exchange is not in front of it. It's on the dang street. And you can't see the street, the front of the stock exchange, because there's construction everywhere. I think the entire city of New York is under construction.
Did you all take a picture with the bull?
No, because there was about 4,000 kids on the bull. And I go, should I kick these kids off this bull and go take this picture? Would that be? Yeah, that might not be good. That reminds me of a Seinfeld episode. The kids, get out of here, kids. But no, we didn't do that. But we did meet two of the icons in the industry. I'll just give an example. Robert Shiller and Roger Ibbotson are both Yale professors. Robert Shiller is famous for inventing the Shiller PE ratio. It's a forward-looking price-earnings ratio. Also, he won the Nobel Prize for economics. Roger Ibbotson is famous for the Ibbotson charts. If you remember back in the day, every brokerage firm, I don't care if it was Fidelity, Merrill Lynch, J.P. Morgan Chase, any of them, first thing you saw in a brokerage firm was always an Ibbotson chart. Basically shows you, all right, if you put $1 in T-bills, it's worth $38 in the last 100 years. If you put $1 in long-term government bonds, it's worth $400. But if you put it in stocks, it's worth $5,000 for every dollar. And so basically, he's a big proponent of stocks because stocks do beat pretty much everything long-term. And that is a fact, folks. Don't let anybody that's trying to say an annuity or a life insurance policy don't tell you that the stock market's a casino or Wall Street, because it's not. There's nothing wrong with the stock market. There's nothing wrong with an annuity. You just got to stay with the low-cost ones, because I do have a problem with anything with high cost. Whether that's a mutual fund that's high cost, an annuity with high cost, anything that you're paying more than 1-2% fees is 2% is really stretching. I'll put it right there. That's really stretching it. But that's what. There's nothing wrong with any of these things. They're legitimate financial products. Anybody tells you, I hate annuities, you should too, they're just selling you a competing product. They're selling you their managed program. If they're telling you, I hate the stock market, it's a Wall Street casino, who would gamble your money like that? They're just trying to sell you a life insurance policy, an annuity, or some private thing. And be careful with the private investments. You know, we've talked about that before over the years. Private investments are never good. They work about 1% of the time. Guy and I have 60 years experience together. And together, 60 years. And we may have seen 2 private investments work out that entire time. Now, don't get me wrong. You hear this 20% secure investment units, New York real estate property commercials, you're all this kind of stuff. Oh, my gosh, yeah, New York real estate. I've never seen, like I said, some of them might work. Remember the life settlements a few years ago? You're buying people's thing. So stick with your tried and true stocks, bonds, annuities, life insurance, stuff like that. And there's nothing wrong with dividend stocks. Stick with all that stuff, and you'll be pretty good. Well, we went there because there's a problem right now with bonds. Interest rates go down, bonds go up. Interest rates go up, bonds go down. Well, the bonds reached the bottom about a couple of years ago, and that created a big problem. We'll talk about it when we return from the break. We're going to show different things to replace bonds or how we can buy a safer kind of bond when we return from the break. If you have any financial questions, don't hesitate to call us, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
That's right. No sales pitches here. Guy, why don't you tell us about yourself?
Well, I'm just handsome and brilliant. Nothing old like you, Victor. Nothing old like you. Hi, everyone. Sarah Meyer here. Hope you all are enjoying the show with us.
Guy was in a farming accident, and his voice is a little higher in the pitch now.
Goodness gracious.
So, Sarah, you've been with us many years.
How many years? That's a test for you.
Oh, my gosh, like 5 years, I think. You've been my executive assistant. You're my right-hand man, woman. And like I said, you're the first millennial I've met that really works hard. So congratulations. You should get like a trophy, right?
Thank you. A raise, yes.
Well, let's not talk about that. Next topic. We're talking about Roger Ebbetson and Robert Shiller. Okay, so we're in New York. So we're listening to the problem we have right now is, remember, once interest rates got to zero, the Fed funds rate got to zero, I guess about 3 or 4 years ago, there was nowhere for bonds to go. So not only do yields on bonds go down, because remember, everything's based on the Fed funds rate. Your mortgages, everything is based on the Fed funds rate. So it's down to zero. So your treasury bonds, like your 10-year treasuries, got down to like 1.8. Now they're higher now. Everything's about 3.5 or so, 3.5. But the issue is the Fed's raising interest rates. They can't stay down long, so they're raising these interest rates, and so bonds are going to go down. So wait a minute. I've got a stock and bond portfolio. Everybody knows that as you get older, you should have more money in bonds, right? You have more stocks when you're younger, more bonds when you're older. Think about it. It's called the rule of 100s. It's 100 minus your age is the most you should ever have at risk. Now, I'll do an easier rule of 100s. The same thing is said is whatever your age is, that's how much you should have safe. Now, you can vary a little bit. So if you're 70 years old, does it make sense to have 70% at risk when you're 70?
Nope.
Or 30? Right?
30.
So same thing if you're 90-year-old. You think you put a 90-year-old 90% at risk? No, maybe 10% at risk. Now, they tried to make variations on this through the 90s. They tried to say, no, it's 120 my age. That is an antiquated deal. But you know who invented those? Mutual fund companies. Mutual fund companies. They've all gone back to 100 now. So trust me, one way or the other, you need part of your money in either cash. There's nothing wrong with cash. It just doesn't pay anything, right? You're losing money to just inflation. If you got a sizable portfolio and you got $5 million in cash, even modest inflation, you're losing purchasing power every day. So what happens? Most people have a lot of bonds. But what happens now? Interest rates are going up. The Fed's making them go up. So we're going to lose money on bonds. Now, why did we get more bonds as we get older? That's because we're trying to hedge the stock risk. So let me give you an example. You have stocks at a 9-year high. Okay? They've gone up 9 years in a row. There has never been a 9 or a 10-year in a row, so we're in new territory right now. So odds are you're going to have a correction. The Shiller PE ratio is like 32. Anytime it's got above 30 in history, the next 15 years, the most money you ever made was 2.1% a year because the stock's too expensive. So you've got that. Then you've got interest rates going up, so the bonds are going down. So instead of having a portfolio that hedges each other, in other words, stocks are going up, the bonds are hedging it, and vice versa, now we got a double anchor because both of them, stocks got to correct themselves. All right, think about it. Would you buy a company that took you 32 years to get your money back? Think about that. 32 years. In other words, if you took the stock, all the outstanding stock, into the price of that company, so every time we buy anything in the S&P 500 as an average, we bought anything, it'd take us 32 years to get our money back. Who would do that? Would you buy a franchise that took you 32 years to get your original money back? Of course you wouldn't. But that's exactly the price of the stock market right now. So on the other hand, now think that's the issue with stocks. The issue with bonds are interest rates are going up. I can't hedge a portfolio with something that's going to lose money. And they're higher yielding kind of stuff, like high yield bonds that used to be called junk bonds. It's the exact same thing. They couldn't market junk, but it's easy to market something high yield. I like high yield stuff. I don't want anything junk. That doesn't sound like a good investment, right? So you've got that. We got two issues there. Well, the issue that they were going to, that Robert Shiller and Roger Ibbotson were going to discuss was, what do we do about bonds? Because it's not a good hedge right now. They realize how much the stock market's overvalued and how bonds are going down as we speak. And so they were trying to come up with all kinds of different things. You know, they talked about cash. Cash is good. At least it doesn't have interest rate risk. But cash, you lose money to inflation. CDs, you got to go to an internet bank to get 2% on a CD nowadays. You might get lucky. There's a couple credit unions that throw them, pretty decent every once in a while. So they ran all the different gyrations. Now, these are Yale professors and Nobel Prize for economics people. Not the greatest personality people, but I'm telling you, the smartest people you'll ever talk to when it comes to finance stuff. And you know what they came up with? What's actually shocking to me, they came up with their best solution, they believe, is a fixed index annuity. Now, this is the same fixed index annuity that I've been talking about on this radio for 20-something years. Supposedly, I was the first one in the United States to talk about these kind of things, and all the other radio stations spent weeks on what a jerk I was. Like, we'll never do that. Every single major firm in the world sells index annuities now, fixed index, every one of them. And now all the academics are saying, hey, this is what you should do. But it's after years of bashing me for it. My clients have made anywhere from 4 to 9, 10% a year on these things for 20 years. And so they're pretty good. But we'll talk about more what they found in this study. And I'll send you a copy of it as well. Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Remember Guy had the farming accident. His voice is a little higher now. Guy, are you still here?
Of course, still here,
right. Somebody told me one time, boy, that guy's a big voice. I go, try sitting next to him for about 25 years.
You should hear him sneeze.
He's a loud one. And like I said, I've been pretty loud my whole life. Anytime I've ever at anywhere, I'm not the loudest one in the room, something's wrong. Right? Until Guy comes in the room. And then he makes me sound quiet almost.
Oh, my goodness.
All right, we're talking about that Roger Ibbotson now says you should consider the alternatives. He's done this white paper. Now, this is an extensive study that showed if you replace bonds, because remember, bonds have the issue we've got now. Interest rates go up, bonds go down. There's nothing we could do about rising interest rate right now. They're going up. So when you've got that portfolio that you have that needs to be 50% stocks, 50% bonds, there's a big issue with a 50% bond side because you're going to lose money on that, and it's supposed to be a hedge. Okay, so you got to be very careful there. And he said index annuities, he likes the no-cap ones, which there's plenty of no-cap index annuities that have done fantastic. But he said every time I plug those in, every single time, we lowered the risk of the portfolio and increased the return. So this isn't Ken Fisher that hates annuities that's telling you they're no good. This isn't somebody like on the radio that only likes annuities telling you stocks are no good. This is one of the most pro-stock guys on the planet that's a Yale professor in conjunction with a Nobel Prize for Economics, Robert Shiller, that's telling you need to really consider this because bonds have issues. You can't be 100% stocks into a 9-year bull market, all right? But you can't be 100% cash either because you're losing so much purchasing power. And we're starting to see upticks of inflation lately. We haven't seen it in years, but we're starting to see that. What you'll get with this full employment is you'll start to get some inflation stuff in there. Rising interest rates, you kind of see the thing. Now, remember, this will not be 1980. Your CDs are never going to pay 15% again. It will not happen. I always have people tell me, I'm just waiting for that. I'm waiting for at least a 9% CD. It will never happen. CDs will never be that high. Somebody goes, well, how do you know? The reason I know is because we adopted European policy when it comes to interest rates manipulation. Back then, we said it's a free market. We're the number one free marketplace in the world, right? United States.
Right.
We said rising interest rates are good. Inflation is good. It cools off an overheated economy. But it was so bad, and the recession was so bad after we just let them go back in 1979 through 80, that it wasn't good. Europe didn't have the issues, didn't have that long recession we'd had, because they always controlled those interest rates. So now, if you ever see a CD get around 5% or so, just watch the Fed. They'll beat down interest rates 15, 20 times to get it back down. Because what they care about is not they really don't care what interest rates. They don't care what CDs you're getting in CDs or your bonds. They care about keeping the economy moving, right? And what moves their U.S. economy? Well, real estate's a lot of it, right? When you have low interest rates, you can expand your business, get business loans for cheaper. You can buy homes for cheaper. People don't buy the price of a home, they buy the payment. 90% of the time. So if you got a low interest rate, that price can go up, and you got the wealth effect. Who doesn't feel wealthy when your house is going up? It's an actual psychological condition that we have. When real estate's going up, the economy's going up, you feel wealthier, you spend more freely. I think 80-90% of our economy is what we spend. And so they've learned that is what it is. So that's why they're always going to control real interest rates. You're not going to have anything like that. But remember, they looked at, all right, what if you took 25% of your bonds? What did that do? How about 50% of your bonds and put it in fixed index annuities? What did that do? How about a 75, 100? Every single scenario, you had better returns and lowered your risk. And you should see the results when we have rising interest rates. It's even better. I will give any of my listeners a copy of this report. Hopefully, you're a numbers nerd like me. That's why I think the largest percentage of clients I have, engineers and doctors. Because a lot of engineers love numbers. I love numbers. The only problem is every time I give a spreadsheet out there, they try to do shortcuts on all my formulas. They always go, no, I figured out a better way on that one formula. You had the right answer, but it was a long way. I shortened it for you. I go, well, thank you. So I've had like 40 engineers go through my spreadsheets adjusting the formulas because I taught myself Excel one weekend 15, 20 years ago. And so I only learned the long way. So now I'm really learning the other ways. But remember, think about it. Bonds, you have a problem. Cash, you have a problem. All right? CDs, we have a problem. They're just not making anything. Nothing wrong with a CD. So we're looking at an alternative to bonds that gives us more return, less risk, more consistency of return, and properly hedges the stock portfolio, not like a losing bond does now. We got more coming up, folks. We got a break. But remember, call us if you have any questions, 972-715-2424, or you can go to our website, ilovemyretirement.com. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome to the Common Sense Investing Show. I'm Victor McClure, and my fill-in for Guy Allert, Miss Sarah Meyer.
Hello.
Like I said, she's the hardest working millennial out there. I'm just letting you go to you other millennials.
I think I may challenge you.
Let's step up.
I think I may challenge you with that. I think I may work just as hard or maybe a little more.
It might have been. When I was 30, though, I was working like 16 hours a day, 6 days a week.
That's because you're working just enough to, entertain the ladies.
Yeah. I got off at 8 o'clock. I got off on Saturdays. I'd work till 9 o'clock during the week. On Saturday, I worked till 8. And I was interviewing some financial advisors. We just hired 4 new ones, right?
Mm-hmm.
And
yeah.
I was interviewing them. I told them that story. I thought all of them were going to pass out. They're like, he's not going to require me to work that much, is he? I go, no, unfortunately the law has now made that illegal.
That would be the ultimate test, though.
Oh, that would be. I was looking for one of them that wouldn't flinch. Every one of them looked like a deer with the headlights. In the headlights, like, really? Is that what this is required? I said, yep. It's going to be the greatest job you ever had, and you're going to work real hard. The people that survive, you'll do great.
Right.
Well, how many people survive? I don't know. 1 in 20.
Yeah. We'll see with this lot what happens.
That's what's so interesting to me, because, you know, if being a financial advisor, they used to call them stockbrokers. We were stockbrokers. They didn't have financial advisors back then, but stockbrokers. You know, the average career is 2.5 years. 2.5 years. So between Guy and myself, we got 60-something years. I'm too young to have 30 years. I must be wrong.
Oh, yeah?
Because, you know, I'm just about 38. That's what I told my wife anyway when I met her.
Yeah. I still remember the day where you started growing your beard and all that white hair was evident right on your chinny chin chin.
I have no idea what you're talking about. There's no way. No, I'm just glad I have hair. That's all I'm saying. Guy's more challenged. See, he's not here to defend himself. It's even funner, right?
Yeah, but you're vertically challenged, so we'll just leave it
that's
there.
True. That's true. I'm not 6'3". Dang it.
Dang it.
All right. What we're doing is we're talking about the portfolio. You really need to look at a strategy to hedge your stocks and your bond portfolio, or in other words, your equity and your fixed income portfolios. We talked about, like I said, the most pro stock person in the world. They have no skin in the game. When an annuity guy or what's it? Those commercials talk about betonyourself.com or whatever. They have skin in the game. They're trying to sell you an annuity or trying to sell you a life insurance policy. Ken Fisher, the Hates Annuities, he's trying to sell you his managed program. What about the academics, the Nobel Prize winners? And they say, here's what you should do. And what I'm saying is, everybody shouldn't do anything. But you might want a copy of this report, because it really opened my eyes. After saying this stuff for 20-something years, having the academics finally doing what I said 20 years ago is amazing. But that report, we can send that to you anytime. Our number is 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. Remember, we're at the Star, the home of the Dallas Cowboys. We are Patriots here. And so if you're not a Dallas Cowboy fan, we will still help you by protest. We will still help anybody. My neighbors, I live in Prosper, and I'm the only, there's one other Texan in my entire block. I've got Pittsburgh Steelers flags in yards. I've got Green Bay Packers stuff. My son, my 15-year-old, goes to school. He goes, there's not hardly any Cowboy fans. I'm like, what? This is still America. I don't understand. So it hurt my heart. But apparently there's a lot of transplants in Dallas now. I love them too. I've been in the military. I lived all over. So I learned one thing. People are people. If you're in New York, they're just as nice as anybody else. They're just as good. If they are raised a different way politically, that doesn't mean they're a bad person or they're stupid or they're ignorant.
Right.
It's just different. When you get down to the Common Core, 99% of everybody are pretty good people. Then you got that 1%, the Philadelphia Eagle fans. That's a different story. I'm not going to talk about them. They're throwing batteries at Santa Claus, for God's sakes. So we can't talk about them. But remember, if you think about it, all we're doing is, remember our bucket strategy. If you listen to us for a long time, there's 3 buckets you should have your money in, right? You got your reserve bucket. The reserve bucket's where you got your cash for emergencies. Anything that happened with your kids or your grandkids. If you got any kids like I do, they always need money. There's always something going on. Every relative that I have from East Texas always seems to need money or something. You got to have that. Then you got to have your income bucket. This income bucket, you can start it when you're 40, 30, but that's the money you're going to live off the income from this particular money, right? Whether it's CDs, annuities, bonds, whatever. And then you've got your growth bucket. And what is the best thing for growth in the world, long term? It's stocks. Anybody tells you stocks are bad, they're not an advisor. They're a salesman for something else. There's nothing wrong with stocks. But all we're doing is, how do you allocate money within these buckets? We're talking about the Roger Ibbotson and Robert Shiller. They're recommending considering an alternative to bonds inside your income bucket, okay, or your safe bucket. It can go into some of the reserve bucket if you, as long as you have enough liquid. You always got to have liquidity is extremely important, especially the older you get. You know, they used to say that you should have 3 to 6 months worth of expenses in cash. That's hogwash, because that can't be the same rule for a 30-year-old as a 70-year-old, right? Once you get closer to retirement, you should have 1 to 2 years worth of expenses in cash. So think about it, folks. You got $10,000 a month in bills. That's $120,000 to $240,000 in cash. I know it's not paying anything. I know you're going to be pissed, but you need it. It's there for a purpose. And we'll talk about the other buckets when we return from a break. But remember, you can go to our website, ilovemyretirement.com, McClureCapital.com also. It goes to the same place. You can call us at 972-715-2424. We got a break coming up. This, folks, you're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. All right, we're talking about your bucket strategies. Some people call these different things, you know, how you allocation strategies or whatever. I like buckets. It gives me a visual. Remember, let's repeat what they are. You got your cash bucket, reserves bucket. For anything kind of emergencies might come up, you need cash, your brother-in-law needs bail, whatever. That's your cash bucket. All right? Then your income bucket, that's going to be what you're going to live on in retirement. Now, if you're one of those people that can live on Social Security, or you got a big fat pension like a teacher or something like that, and if that pays your expenses, that's fantastic. You don't need as much in these buckets. You still need that reserve bucket, but your income bucket could be smaller because your expenses are taken care of by other things. You can have more in your growth third bucket, which is the growth bucket. That should be stocks. Now, there's a lot of different ways to put stocks in a bucket. Some people like individual stocks because the taxation on them is more favorable. You know, long-term capital gains and things like that. More favorable than mutual funds that might spit out short-term and long-term gains. I'm a big fan of ETFs and index funds. Remember, don't pay high fees to anyone ever. Anybody tries to offer you something with high fees, just ignore it. You can't pay high because if some of these variable annuities out there are charging 5% a year in fees. Now, let me put yourself in my position. If I'm receiving 5% a year in fees, I am smiling. I'm happy as you could be. There's no way to make me happier. 5% a year, think about it. Manage $1 billion, you're making a fortune, right? Now, what if you're the person that bought that? That can't be good. Think about it. The S&P 500, since 2000, this century, has made 4.97% per year with dividends and zero fees, which is impossible to buy anything with no fees. You can get them really low, like an index fund or an ETF. Can't get no fees. But even if you could get that, you ate up in fees. There's no way you should ever pay more than, I'd say 2% is a stretch. You know, but 1%, 1 to 2, max. What I try to do with most of my stuff is try to get zero if possible. If there's a zero alternative, that's the first thing I'm looking at. Okay? So, you've got your cash bucket, and you can have CD ladders in that. You know, you got to have enough on the completely liquid side, though, like money markets or checking savings. Keep enough because, you know, you never know. That uncle of yours that always gets put in the pen, whatever, you got to get him out. You never know. Never go. Then you got that income bucket. And what we're talking about for most of the show today is the Robert Shiller, the Nobel Prize winner in economics and inventor of the Shiller PE ratio. Roger Ibbotson, the Yale professor and inventor of the Ibbotson charts. Everybody in this business knows who that is, both of those. And they're saying maybe you should consider index annuities as a bond alternative. They beat the return, and they've decreased your risk in every scenario in a portfolio that they put them in. Now, these are the uncapped ones. If you want to go, there's some uncapped ones right now that you back test them. They're like 5 to 8% a year. That ain't bad for something safe as a CD. Think about it. The market made 4.97 for the last 18 years. Don't let anybody tell you they made 20% a year or 10% a year, because that is hooey. That is hogwash. Now, over 18 years is a long time, right? That's still like 2.5 times your money, or 1.5 times your money, 150% profit there. Not bad, but it's 4.97%. And so 5 to 8 without worrying about the risk. Remember, bonds go down as interest rates go up, which they're going up right now. So it's another way to hedge your portfolio. It's not like the old ones. The first generation of a lot of these index annuities were capped. And so you could only make the first 5%, 7%, or whatever. These are uncapped. So you get up years of stock market indexes, guaranteed to never take a down year, locks in your gains as you go. It's judgment proof. I don't care what you do, nobody can sue you. Now, I'll change it. There's only two things to touch it. Nobody can sue you and touch the money ever, but divorce and the IRS can pierce them. That's the only two things. And divorce and IRS can pierce a lot of things. I think nothing can. So most states they only have a judgment proof up to a couple $100,000, something like that. Texas is unlimited. That's why you'll see so many smart people have some low-cost annuities, not high-cost crap. Low-cost annuities, because it's judgment proof. If you're a doctor and there's so much litigation going on, it's not bad to have something that's judgment proof. And it's tax deferred. Think about it. All the money you would have paid in taxes gets to compound on itself. So what it's called is triple compounding. So that is a better way than having a bond that's losing money right now. The best you can do is buy individual bonds, hold them to maturity, and still the greatest return you're going to make is 3 to 3.5%. 3 or 3.5 is the absolute best you can do. If that's the best you can do, why wouldn't you do something else that has no interest rate risk, can't lose? And so that's what we're trying to do. Remember, we'll send you the free report. It's the Roger Ibbotson report that shows you when you put this instead of bonds, index annuity instead of bonds, what it does for a portfolio. And it's amazing. Our number 972-715-2424. Again, 972-715-2424. Go to our website, ilovemyretirement.com. It's been great to be on the air again. Like I said, I tried to move I had marketing people telling me move into the 21st century, get off AM radio. Everybody listens to podcasts now. You got to be on the thing. So we're on all that. We're on the YouTube and all that stuff. But I guess I'm old. That's why me and my neighbor Gary, he's about 70-something, we're the only ones walk out and getting the newspaper every day. We're old school. To me, you got to be on the air. That's the way it is. So remember, if you have any questions for us, like a copy of any of the Roger Ibbotson report, don't hesitate to call us, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.